This episode addresses angel investors along with angel funding. An angel investor is a person of means who invests his or her own money in a company, usually a startup that is in the early stages of development.
Our Favorite Tools for Entrepreneurs podcast addresses tools and concepts that are useful for the launch and growth of entrepreneurial ventures. Your two hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Hello, Ryan. How are you doing?
I'm doing fantastically. What about you, Professor Palin?
The new year's starting off great so far. Ryan, today I wanted to speak a little bit about angel investors as a funding source. We've already talked about bootstrap, but angel investors is another area that a startup can gravitate towards to secure funding.
Absolutely. I think it's one of the biggest ones, especially in the beginning.
It's a term that many people are familiar with. It's just not a natural term to refer to someone as an angel. But basically, an angel is a wealthy person or person of means that invests his or her money in a company, usually a startup or an early stage venture. Many people confuse venture capital with angels also. And I've actually had angels who thought they were venture capitalists. So a venture capital is a fund that is run by managers. Does that sound fair?
Yeah, I think the big distinction is it your money or someone else's money?
Exactly. And it makes a big difference. The attitudes towards an angel and a VC are very, very different.
Absolutely. And the expected outcome from the startup should be very different as well.
Definitely. So what is your experience dealing with angel investors, Ryan?
Quite a lot. So I've had angel investors invest in companies that I've owned and started. I've also worked as a consultant for an angel group in Nashville, where I went to their pitch days so I could help them understand emerging technologies and then help them go through the technology if they genuinely were interested in making that investment.
One of the areas that we understand, but many people don't understand, is angels don't typically lend money. They're taking an equity, a piece of ownership of the venture for their investment.
That's exactly right. And typically that angel wants to be more involved in the business than other types of investment as well.
It can be formal or informal. So an angel will sometimes be on your board of directors. Sometimes it's more informal. Where a VC, very often they will have one or two seats on the board of directors.
Right. And they'll typically have a professional staff that's helping you with certain facets of the business.
My experience with angels is you'll have two groups. One group is cashed out entrepreneurs that have been very successful. And then you'll have another segment of people that have high net worth. Maybe it could be a surgeon that's looking to diverse his portfolio, or it could be someone who inherited the money. The reason I put those two groups into distinction, one has experience in entrepreneurial activities and another doesn't. So your guidance can be very, very different.
Yeah. And I think most angels think they have experience, and it's up to you, the smart startup owner, to discern whether that really is experience or whether it's just something that they're bolstering to make themselves seem like the more of a value add.
My experience, you can tell me if you have any different experience, is the angels that have cashed out entrepreneurs, they tend to be more valuable in their guidance than those that have never experienced it. And as you're saying, some who think they have that type of experience who don't, they can become an obstacle. And I would avoid taking their money just because of that.
Yeah, it's commonly referred to as poisonous money. People that get in, want to control the business, and don't really have the savvy to course correct you, direct you in the right experience. So it's much more important where the money's coming from than how much money it is.
Yeah, I agree. Okay, someone listening to this, they're saying, well, how do I find out which of the types that we're speaking with?
Yeah, do your homework.
Yeah.
Look at their portfolio. Often angel investors are willing to talk about it. They're proud of it. See if they've had other experiences that have come to fruition, have ended in some way. Talk to, if they can or are willing to, just depending on the relationship they have with other investments, talk to companies that they have invested in. It's just like any other business. You want to know their background. And I think a lot of angel investors are willing to share that if they're serious about the game they're playing in.
That's one that I think is very important, talking with people that the angel has invested in. That discussion can be very eye-opening from two different directions.
The first time I ever took money from an angel investor, undoubt it would be called poisonous money. They ended up sucking a lot of time out of the business, directing us into some areas that we shouldn't have been participating in. And ultimately, it was a big struggle. And they controlled a big portion of the company. So we couldn't really say no to them at any time.
So basically, that's referred to as due diligence, doing your homework and your background on the angels. Very often, due diligence, people perceive it as the investor looking at the company doing the due diligence, but it goes both ways.
It does. And you should expect the angel investor to do some sort of due diligence on you and be prepared for that.
Absolutely. I've always been very open to that, and I've encouraged that. Also, angels are looking for a clear exit strategy, because they're not in this to own a business, to have a job. They're looking to cash out at some point. And especially the cashed out entrepreneur that wants to get back into the game, they don't necessarily often don't want to start their own business, but they like to still dabble in this field of entrepreneurship. And this is their way into it, but they still want to see an end game where they can cash out.
Oh, that's absolutely mission critical, is some sort of cash out date, whether that's another round of investment where their investment gets diluted and they take some cash out at that time, or a sale of the business.
Sometimes it's a one-time injection up front. Other times they will work with you as you need various rounds of funding to build the business before you exit out.
A lot of angel investors are also members of angel groups. So maybe they'll be the sole angel for one round if you're just out of friends and family, or if you're not doing a friends and family round. And then they can bring a group into a larger investment down the road. I always look for angels that are parts of angel groups. That's typically a sign of sophistication. It means they probably know a little bit more about how the game works, how they can help. And it also does open you up to those future rounds. Unless the angel is exceedingly wealthy, typically they are going to cap out at a certain amount of funds. And then that also comes down to comfortability. What is their investment level? How much does that look like each time? That should also be part of your due diligence process.
The concept of angels has morphed since I've been in the entrepreneurial field. It started off with just individuals of wealth were angels, and then it became more sophisticated with angel groups working together. And now it's morphed to, some of them are referred to as super angels, which are looking more like VC firms. So you have to understand who you're playing with.
Yeah, the level of sophistication in angel groups is pretty amazing. The one that I did some consulting with was very, very sophisticated. And they had myself as a consultant and two other consultants as well to make sure that they really had a good grasp around these businesses. It was not the willy-nilly wealthy person lending money to the entrepreneur standing in front of them.
Also, the entrepreneurs should do their due diligence on the angel group, because some tend to gravitate towards specific fields. It could be, say, medical, could be some type of specific software. The process of investing can be different. Some will be you're making a pitch to a group of angels, and then they can get involved individually, form informal groups. Some only will invest as an angel group into businesses, or different combinations of that. Is that what you've seen?
Yeah, absolutely. Different combinations all along that trajectory. Even some people diversifying their risk and bringing a much larger group, not just the people sitting in front of you, to take a smaller personal risk and still get the money that's needed to drive the business forwards.
Definitely. Bottom line, do you due diligence on who you're presenting in front of, whether it's an individual angel or if it's an angel group?
Right.
Now, another difference from angels to venture capitalists is the amount of money that they will invest typically.
Yeah.
My experience is angels, you'll see typically ranges from 10,000 to 100,000, could be higher specifically with groups, where venture capital is much more money. Usually they're starting around $2 million and up.
Yeah, I would say there's some flexibility with those numbers. If you're looking for a ballpark, I'd be fine with establishing those ballpark numbers. In the VC groups, typically aren't the really early stage investments. They want to see some proven track record from the company they're investing in. So they will start at a higher number.
What about the concept of accredited investors? Do you mind touching on that?
So accredited investor, I'm not going to go into the very specifics because you should look at it. It changes every year, is why I don't want to put it in a true definition. But essentially, it's an individual that can prove they are liquid enough, so they have enough liquid assets to make investing a proper decision for them. And that's a bar set by the federal government. It's over $250,000 roughly in yearly income, or over $1 million in liquid assets are the very rough numbers that they have to prove to be considered an accredited investor.
I believe it's the SEC that makes that distinction.
Yes. But again, big disclaimer, it does change year to year. So make sure you do know.
And also, if you're moving in that direction, you definitely want to speak with an attorney to make sure you're doing this properly, because you don't want to be on the wrong side of the SEC.
The importance of an accredited investor is an accredited investor from a federal government standpoint can put their money wherever they want. And they don't necessarily have recourse on where they make decisions to put their money. The reverse of that, and why it's important, is if you take money from somebody that is not an accredited investor, they actually have recourse against the business, and typically the people that own that business. So they can come and say, look, I didn't understand what I was investing in. I didn't have the means to do it. You've failed, and now you owe me this money back.
It's also a barrier so they're not scamming grandma.
I think that's probably the origins of it. And now it's a hurdle that is in place for reasons like that.
And if you're dealing with accredited investors, if the business fails, it's not like a loan. You're not personally on the hook to repay that. That money goes away with the demise of the venture.
Right. Again, I'd talk to your lawyer to make sure that the agreement you're signing with them, because there will be some sort of an agreement that goes along with an investment, does outline that. But that is the standard. That is what people expect.
Yeah, that is the traditional, but you're absolutely right. I'd like to reiterate, you need to speak with an attorney about this, because you don't want surprises at the end of the game.
Yeah, that's for sure. Especially when tensions are high. If a business is failing, everybody wants their money back.
One other area before we finish up, and again, I'd like your opinion on this. My experience is that typically angel investors like to be able to drive to their investments. So I always start looking geographically.
That's funny. I don't actually know if I have that as a criteria in my echelon that I pull out. Thinking back to investments that I've received or being part of organizations that they have received, that seems to ring true. But I don't actually know that is something I would have told somebody. That's funny.
Again, there's no absolutes in any of this, but it's typical that they like to drive to their investment.
Totally,
and it makes much of the interactions, the mentoring, not just the funding, easier. Again, but I've had angel investors that came from across the country and flew in for the board meetings. So there's always exceptions to this. Now, what about associations for access to angels, like Angel List being an example? What are your thoughts on that? I think Angel Capital Association is another one I'm familiar with.
So there's a bunch of online repositories of angel groups. Angel List is probably the biggest one at the moment, and it definitely has a lot of verified angel investors on it. So people that have actually funded, not people that are just signing up for a website to peruse companies. I have been a consultant in 2 startups that got their investment through Angel List. A lot of these repositories, not just Angel List specifically, help with the investment process. So they have a lot of the agreements in place that are able to be used by the startup and the angel to form whatever sort of relationship they have for the investment to transfer hands.
And the last point I'd like to make is you don't have to choose one over another. For example, you can start off bootstrapping, build a company to a specific level. Then when it's more prepared to deal with angel investors, and you get a better valuation by doing this. And if it's an extremely high growth business, then you can move on to venture capital. So you can actually use all 3 or just use one of the concepts or 2.
Another important thing with angel investors, if depending on the amount of money that you need to raise, it is okay to combine different angels together in a round. So that's why they're called rounds. It doesn't all have to come from a specific person, just depending on the amount of money, the amount of risk that each angel wants to assume, and their diversification. Sometimes it's really important to get different people with different backgrounds in on the same round so you can diversify the advice that you're getting as well.
Yeah, I agree with you. And you have to be careful with valuation on that. I always like to come up with a common valuation.
Or avoid a valuation together and do a safe agreement. But that's a topic for a podcast, different podcast.
That's true.
I've had many people liken getting an investment to getting married. You're really going to be close to this person for a long period of time. So you better make sure that your cards were put accurately on the table.
So be transparent.
Exactly right.
Are there any other final comments about angel investing before we close out?
I'll just leave with the piece of advice that I talk most often about with angel investments. It matters a lot more where the money is coming from than how much money it is.
I agree with you 100% on that.
There we go.
But you have a great day, Ryan.
You as well.
Thanks.
Thanks for listening to our Favorite Tools for Entrepreneurs podcast. As always, you can head over to ProfSpirit.com to check out more resources and courses designed for you, the entrepreneur. Please follow us on Spotify, Apple Podcast, YouTube, and others to get the most up-to-date information as it is released.